Today's market moves weren't really about direction. They reflected a deeper uncertainty in how investors are thinking about growth, policy, and geopolitical risk over the next few weeks. Markets closed essentially flat, but under the surface there was a clear tension. The S&P 500 and Nasdaq edged slightly higher, while the Dow slipped modestly. It looked calm on the surface, but that calm came from hesitation, not confidence. At the same time, other asset classes told a more decisive story. Bond yields moved lower, suggesting investors are starting to price in slower growth or a potential policy pause. Oil prices pushed higher again, holding above the $100 range, reinforcing supply concerns. Meanwhile, gold fell sharply, which is unusual in a risk environment like this, and the US dollar remained strong. So what changed? The key shift came from geopolitics. Markets had been leaning toward the idea that tensions in the Middle East might ease, but that assumption was challenged. A more aggressive tone from the US signaled that the conflict could extend over weeks, not days. That reduced the probability of a quick resolution and kept pressure on energy markets. At the same time, there were small signs that diplomatic channels are still open, which created a push and pull in expectations. This is important because markets are no longer reacting to a single narrative. They're bouncing between two possibilities: prolonged conflict with sustained supply disruption or partial stabilization through diplomacy. And that uncertainty is exactly what showed up in today's price action. When you look at how capital moved, the behavior becomes clearer. Investors didn't aggressively take risk, they repositioned selectively. Real estate and certain areas of technology held up well, particularly semiconductors, where AI-driven demand continues to act as a structural support. At the same time, consumer discretionary stocks were sold off, especially after weak signals from major companies pointing to pressure on consumer spending. Energy remained supported but not chased aggressively, suggesting institutions see it as a necessary exposure, not an opportunity for risk-taking. What this tells us is that money is becoming more defensive, but not fully risk-off. It's a controlled repositioning, prioritizing stability, cash flow visibility, and structural growth themes, while reducing exposure to areas sensitive to consumer weakness and rising costs. But beneath this, there are some fragilities that the market may not be fully pricing yet. One is the physical reality of the energy supply chain. Even if tensions ease, infrastructure damage and production constraints could take months to normalize. That means higher energy costs may persist longer than expected. Another is the growing pressure on the consumer. Today's sharp decline in discretionary names is an early signal that higher energy prices and inflation are starting to affect spending behavior. And then there's the policy constraint. The Federal Reserve is increasingly caught between two forces, slowing growth on one side and energy-driven inflation on the other. That limits how flexible policy can be. All of this leads to a bigger macro signal. Markets are no longer trading a clean growth versus inflation narrative. Instead, they're navigating a more complex environment where geopolitics, supply shocks, and policy constraints are interacting at the same time. That's why you're seeing mixed signals, like oil rising while equities hesitate, or gold falling despite elevated risk. It reflects a market that is still trying to find a stable framework to price the future. An interesting question investors are debating right now is whether this environment is just temporary headline-driven volatility or the early stages of a more sustained repricing of growth and risk. I'd be curious how you see this. Is the market overreacting to short-term developments or still underestimating the longer-term impact of the ongoing conflict? Looking ahead, the next phase will likely be shaped by a few key catalysts. The labor market data will be critical, especially in understanding whether growth is starting to slow more meaningfully. At the same time, any updates on geopolitical developments, particularly around energy supply routes, could quickly shift sentiment again. And beyond that, inflation data will remain central because it directly affects how constrained the Fed really is. The broader takeaway from today's market reaction is that investors are becoming more cautious, not because of what has already happened, but because of how uncertain the path forward has become. But markets rarely move on a single narrative, so I'd be interested to hear how you interpret today's signals. If you enjoy this kind of calm, analytical breakdown of global markets, consider subscribing. I share regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.